All right, we've been covering a lot of earnings stories so far today. And in Canada, fintech Propel coming out with its quarterly results. The company also boosting its dividend. The CEO joining us here in studio to talk a little bit more about the business. Clive Kinross of Propel Holdings. Good to see you again. Thanks very much for joining us.
Great to see you too. Time flies around here.
It does. And obviously, this is an interesting point, earnings season, that is, where, with all the headlines people are talking about right now, macro uncertainty, what's happening with underlying businesses. How would you describe what's been happening with your business of late?
Yeah, you're right. There certainly is a lot of uncertainty. And as we like to say at Propel, uncertainty spells opportunity for us. And let me try unpack that a little bit, John. What we're seeing across the credit spectrum is tightening by the big banks and credit unions. In fact, more so in Q2 than we've seen since 2014. The New York Federal Reserve said that turndowns from banks was 23%, up from 21% in Q1, which is the highest level of turndowns since 2014. And if you were to go a step further and look at the rejections for customers with FICO scores below 680, it was 57%, up from 49%. If you said to me, why are the banks doing it? They're doing it because they're seeing increases in delinquencies, particularly for consumers that are earning in excess of $150,000. Those aren't our customers, but it's leading to the tightening. And that tightening, as a result, is leading to more applications moving to our segment of the market, where we provide access to credit to underbanked and underserved consumers. As a result of that, we're seeing much higher volumes coupled with excellent credit performance. Why excellent credit performance? Broadly speaking, John, there's two reasons for it. Number one is the credit quality of these customers is better than we're used to in the past. And second of all, if you were to bifurcate the market into what I described as that 150,000 plus earner and our customers are doing great. Their wages are going up. There's lots of open jobs for them. Unemployment levels are down. And if you look at where jobs are being created in the US today, that's our main market. Industries like hospitality and education, etc. That's where the jobs are being created. Those are our customers.
So you are in a business that has lasted for decades and decades, if not centuries, but it is the technology aspect of your business that stands out. So can you give us a sense, when you're trying to look at a potential customer for your platform, what goes into that process? How much of the technology can get to the heart of whether somebody is a good partner for your platform, if maybe a bank is not providing the same kind of access that person would like?
Yeah, you're absolutely right. And we've been speaking about AI and machine learning for many years now. In the context of what we do on the underwriting side, it's something called predictive AI. That allows us to look at in excess of 80,000 applications each and every day and render a credit decision in 6 seconds or less. So you can imagine the level of scalability that happens when you're able to do that. To put it into perspective, when we went public in 2021, just under 4 years ago, our LTM was about $100 million in revenue. This year, at the midpoint of our guidance, we're going to do $620 million in revenue, so roughly 6x.
And that LTM means just for
last 12 months. Last 12 months at the time of going public. So revenues increased by 6x. Our employee count went from about 330 back then to about 650 today. So not even a 2x in the employee count, notwithstanding a 6x in the revenue front. And if you said to me what's allowed us to do this, it really is our AI and machine learning as well as more automation. The direction we're taking in AI today, besides the predictive AI that we're using on the underwriting side, is this generative AI that we're using across our organization. We're using more and more of it across our customer call center. It's creating tremendous efficiencies, and we estimate that by the end of this year, and this has been our first full year of implementing it in our operations center, we'll reach about 15% efficiencies, meaning we'll require 15% fewer people than what would otherwise otherwise be the case without it. And if anything, we expect that delta to increase on a go-forward basis.
I mean, there's a societal tension with, companies not employing as many people as before, but we live in a capitalist world where productivity is very important, not just for the economy, but also for the performance of businesses. So, just as an example, and I know one of the factors we watched with Shopify's latest quarter was their ability to leverage AI, and that's what you're doing as well. And I guess I do wonder, you mentioned going public. You've gotten a lot of attention from investors over that period of time. Give us a sense on how big you think this business ultimately can be, given the scalability you were talking about.
Well, initially we were in the U.S. market. That was the market we launched from, notwithstanding that we're here in Canada.
Yeah.
We've subsequently started a greenfield operation called Fora Credit. Fora Credit demonstrated 60% year-over-year revenues in Q2. That's a new big underserved market for us. And we acquired a company in the UK called Quid Market last year, John. We did a $115 million bought deal. We told investors that we thought that business would grow by about 40% in its first year. We're well on track in its first year to exceed 50% growth and may even exceed 60% in the first year. If anything, we expect that business's growth to accelerate. So all of which is to say, we're serving a market comprising about 90 million underserved consumers today. We're pretty confident that we could continue to grow the top line at around 40%, which is approximately what we've achieved year to date in terms of top line growth. We've also said to investors that the operating leverage that we expect the business to demonstrate, the bottom line growth will exceed the top line growth, and certainly for the foreseeable future, we expect that to be above 50% year-over-year bottom line growth, notwithstanding the fact that year to date we're already at 60%.
Real quick final question. I mean, it's actually a question that could warrant a long answer, but I'm going to try to get a quick response. Obviously, it's a complicated time to try to figure out what happens with the interest rate environment, especially in the U.S. where there's those political dynamics as well. Is that a complicating factor in running your business as well, since interest rates obviously factor in a big way to the lending environment?
Yeah, it's a great question. And obviously our cost of capital is one of the big costs of the business. As the business has grown and matured, we've managed to bring down our cost of capital, which has a variable component tied to SOFR, which ultimately follows the Fed fund rate. So all of which is to say two things. Number one, as we get bigger, our natural tendency is to raise debt capital at cheaper rates. In terms of what's going on with Fed fund rates, I do think that you're starting to see a little bit of a slowdown in the macro economy, and I think that central banks, as a consequence, will lower rates, and ultimately that will be a tailwind to our business, as that's one of our costs, and any reductions over there go right to our bottom line. I think we're at that point now where the Fed's about to start lowering rates.
People have been talking about that definitely over the last week or so. Clive, thanks very much. Appreciate the time.
Thanks
Clive
so much.
Kinross joining us, the CEO of Propel Holdings.